Welcome to the Wall Street Redneck Channel. Hey y'all, today we're going to talk about volatility. Volatility is something that's always in the market. What you want to do is learn how to gauge the volatility, and I'm going to cover that today to make sure that you don't over leverage your account and wreck your account. I've done that in the past, and I'm telling you that is no fun. So I came up with a strategy on how to look at the volatility and measure it and apply that to how much I leverage into each trade. So we're going to start today by looking at this VIX. The VIX is actually a gauge for the volatility, and it measures the S&P 500. So the VIX is one way to measure the volatility. If you notice, it's at 51.21. There are other ways to measure volatility for other indices, like the VXN, which is for the NASDAQ 100. You've got the VXD, the DXY, all these others that measure for different indices. Okay, so understand that I've looked at all of these and I've found that over time, the VIX is the one that correlates with most all of these others. And I can use that one indicator and know this is what the volatility is moving and looking like today. So I'll give you an example. If it's above 20, I know I need to be paying close attention because we're going to have a lot of volatility. If I'm below 20, I know it's going to be less volatility. Now, how do I measure that? What we're going to do is we're going to go to the next chart and show you how I measure that. Now, what I did is take this NASDAQ 100 chart, and I've put a couple of indicators on there. If you notice, I've actually put the initial balance high and the initial balance low. That doesn't play into this strategy, but I wanted to sort of give you an idea of a range. I'll look at different levels as to not take a trade at that level. I want to take trades that are either moving towards that level or moving away from that level. Now, if you notice also, there's a box on here. That's what we want to stick to for the point of today. The point of today is to not over leverage your account. If you notice, I'll go to the first candle, which is the first 15-minute opening candle. This is a 15-minute chart, so each candle represents 15 minutes. The first candle has finished and gone to the second candle. Now, a lot of people use that 15-minute opening range, and those are great levels also. Those are things that we're going to cover in a future video about levels and what I look for in those levels and how to trade within them or outside of them. Okay? So if you notice here, the 9:45 candle, that candle has finished, and it shows I just drew a basic box around that candle. And what's the reason I drew a box around that candle? The reason behind it is the VIX is high. How much are these candles moving? What can I afford to leverage on a trade in these candles? Look at this, 220 points. Now, I trade minis many times because the size of my accounts. Okay, I trade prop firms and I trade personal accounts. Now, if I were trading a prop firm account and it was a $50,000 account and say it only had a $2,500 maximum drawdown, I cannot afford to go into this trade with one mini. That's $20 a point. $20 a point at the point of 220 points, multiply that. You could have, if you entered in the middle, that's $2,000 down or $2,000 up, or a $4,000 plus swing within that one candle. That will wreck your account. So let's talk about how we trade during these times. And this is how I apply this strategy. Many people talk about micros as if it's a bad thing. Micros are not bad. Micros are a great way to size down to match the volatility in the market and what you can afford to risk on each trade. So let's use this as an example. That 220 points, if I take one micro, it's $2 a point. If I take one mini, it's $20 a point. I had much rather be risking only $400 on this max swing than I had $4,000. Or if I'm entering in the middle, $200 down or $200 up. You can do one micro, two micros, five micros, whatever your size of your account is. But you need to know that before you get into the market each day on every single trade. So let's just use a simple price action setup. If I were to enter say at this candle here, the 945 pulls back a little bit, comes back up, breaks above the body of this 930 candle. I look left, I'm going to see it reach that high again. So let's just say it's down in the 360 range, and I want to see it get back up to the 420 range. So we're looking at about a 60-point swing. 60-point swing times $2 is 120 bucks, 240 bucks for 2 contracts. If your account would allow you to have up to 5 micros, you're looking at $600, because that's 5 times 2 is $10 a point. You're looking at a move for that. Your account needs to be able to handle those types of drawdowns if you have losses. And you've got to expect to have losses, because you need to have a stop loss and a take profit on every trade. So basically know when you enter what your risk is, what your reward is, and have that measured within what the candle movement is based on the VIX. Those correlate. Hey, if it's a 20, we're going to show that in just a minute. When it's below a 20 on the VIX, the candles shrink. So we're not risking as much. We can leverage a little bit differently on each trade. But here's a great example of how much that market can move. And you see throughout the day, they typically average staying around that size. So you're dealing with a 15-minute candle of 220 points. Now let's go to a day where the VIX is 15.79. That's a great smooth day. Now there's other things that'll come into play, like if Financial Juice has some news coming out on the CPI, it might be any types of news on housing, it might be other things. We'll go over in a video of how to handle watching news to make sure you're not in the market during a trade when they release those news events. Those are real simple to monitor, real easy to pay attention to. But we're going to stick today on the VIX and what it currently is, just saying it's an average day of high volatility or lower volatility. So at 15.79, we go to the exact same chart for that day. Now we're going to use the same type of setup. We've already talked about initial balance high and low. That just gives you an idea of how it's ranged out. If you notice here, the first candle at 9:30 finished. The next candle, I drew the box on. The box shows 57 points in that 15-minute candle. Now, how much easier is it to manage 57 points than 220 points? A lot easier. So if you have a little bit larger account, you can go back to minis at this point. If your account still has a set minimum drawdown and you don't want to risk, it's all based on your personality. That's another thing that we go over in all of this trading that I'm trying to share with you on the internet and on YouTube and on Facebook, is how to manage your personality profile to the strategy that you use. And I've got a test for that too. We'll go over that in a future video also. If you notice here, the Wall Street Redneck Suite is on there. I've got one indicator from my suite on this chart. It's the channel suite, and there's a whole strategy behind all of these. We've got price action strategy that applies to this. We've got this channel strategies. We've got all types of different strategies that I've built over the years that I use on a daily basis. So let's get back to this. 57 points. Look at that. Notice that it's much easier to manage 57 points with your stop loss and take profit. So if you went even to 2 to 5 micros, you can manage that much easier. Go on up, if you notice here, after it established that next candle and you get close to the initial balance, it really starts to stay around 40 points per candle. So 40 points per candle throughout the rest of the day is even more manageable. So all you do at that point is look for those price action setup, use these indicators that I've built, and I'll be sharing those with you in the future as we build a community to all work together to help you become profitable. This right here will help you manage your strategy throughout the day and not over leverage. So overall, the VIX is a great way to pay attention to how much volatility is in the market. Draw some boxes, look at your candles in the time frames that you trade, pay attention to how large they are, leverage yourself either down or you can go back up depending on if it's gotten lower to match what you need to do to stay profitable and stay away from risking too much of your account per trade. This is a good explanation of how to go over that, Look at the VIX, compare it to the size of the candles, use those parts of the strategy that I've built to help you grow and become more successful and not over leveraged. Over leveraging is one of the many things that can wreck your account. And fortunately, I've experienced all those negatives, and I want to share that with you to keep you from having those issues. Okay, so that's a review of all that we're going to cover today in this video. Learn how to use that VIX, learn how to become profitable. Let the Wall Street redneck help you become profitable, and y'all have a blessed day. Hey, take a look at this watch list. I keep an eye on this all the time. Many of these things have correlation, and I want to make sure that I'm looking at how the overall market's working together. Also, this has the VIX on it, and you know how important that is. We just went over all that. So once again, have a blessed day, and thanks for watching.